Hi, this is James Shug with Westpac London's end of day report for Friday, August the 3rd. Well, what the market takes away one day, it can give back the next, and we've certainly seen an extraordinary rally on European equity markets today. It seems that investors have taken a closer look at what ECB President Draghi said yesterday and decided, he's making governments do what they need to do. He's agreed to possibly buy the bonds of problem sovereigns, but as a last resort. In other words, countries whose bonds get bought will have had to have sought bailout assistance. And if those bond purchases take place, they'll take place at the shorter end of the curve, which means that effectively the ECB can keep a close watch on what governments are doing in terms of the economic reform process, and if they're slackening off, they can effectively, quickly and easily remove that support. There's a lot of sense to what he said, and if it all comes together, as I think Draghi wants it to within the next few weeks, then it could prove to be a real turning point in the sovereign debt crisis. Still a hell of a lot to do beyond that, but it could be the event that really marks the serious turnaround in that in the crisis, from the period of markets being in despair that anything can solve the problem, to a period where at least there's a chance that the euro might hold together. That's certainly the view that investors seem to have taken today, and that's why European markets are up very strongly. We've got the London market up 2.2% today, the French market up 4.4%, the German market up 4%, and the Spanish market up 6%, and the Italians up 6.3%. Those last two more than reversing the losses that they saw yesterday. Now, it wasn't just about Europe. There was some economic data today, and I'll run through that too. In Europe, retail sales rose slightly, 0.1%. In June. That's the second consecutive monthly rise, something we haven't actually seen for almost a year, back-to-back rises in retail. But we also saw the services PMI reaffirmed, or revised very slightly, but basically at 46 the composite PMI at 46.5 in July, still around the level it was running through the second quarter, consistent probably with a GDP contraction of around 0.5 to 0.7% in the quarter. The UK services PMI slipped slightly. In fact, at 51, that's its lowest reading since the recession in 2009, with the exception of December 2010, when there was a temporary dip to 49 point something because of the snow disruption, but that was reversed immediately the next month. In contrast, we've had a gradual decline in the PMI for services this year, and that's another sign that the UK economy, although the minus 0.7% second quarter growth contraction probably overstates the weakness in the economy, surveys like this show that there is actually underlying weakness. At best, the economy stalled, and it's probably in a mild recession. But in the US, the big data surprise was the 163,000 jump in payroll employment in July. That's the fastest gain since February, and followed gains averaging just 73,000 in the second quarter. Having said that, if you take the latest 3 months, that's May, June and July, the average is just 105,000, and compare that to the previous 3 months, the average then was 157,000. So we've seen, a 52,000 per month slowdown in the average jobs growth pace, in the latest 3 months compared to the previous 3 months. When you consider the unemployment rate rose to 8.3% from 8.2 in June and a recent low of 8.1 because of a jobs decline recorded in the separate household survey, you get an overall picture of a mixed report rather than one that is particularly strong. I mean, hours worked and earnings growth, both pretty soft, just up 0.1% each. And there was a bit of a boost to the number too from the auto sector, which had a shorter than usual shutdown over the summer period. That may have accounted for about 13,000 jobs, which will probably drop out of the August figure. So the big question is the July number going to be typical going forward, or are we going to see a resumption of soft numbers that we saw through the June quarter as soon as the August result? Because that's the August payrolls number will be the last one before the next FOMC meeting on September 13, and our sense is we're more likely to see a much weaker result, but we won't know for another month. But certainly the jobs story in the US was stronger than expected in the headline at least, and that accounted for some of the gains in equity markets in Europe and also in the US and also in the commodity markets. The services ISM survey rose from 52 to 52.6 in July, but they're still the two weakest back-to-back readings since early 2010. So that survey is showing an ongoing slowdown very much in the US economy, even if the latest jobs numbers didn't show it. And that's about it for the data flow today. In terms of US equity markets, we're looking at a 1.9% gain in the Dow as it's 5:30 in London at the moment, so lunchtime in New York. 1.9% up for the Dow at 13,123. Actually, the S&P 500 is up 2.1% today, just above 2 there, and the Nasdaq's up above 2% as well. In terms of commodity markets, we've got oil up 4.7% today at $91.26 a barrel. If you look at an intraday chart, you can see the oil price is scoot higher on the release of those jobs numbers. Gold prices up 1% today at $1,605 an ounce, and copper prices are up 2.25% today. The Aussie dollar is stronger; it's at 1.0565 against the US dollar, up from up about a cent, I suppose, from where it was yesterday. Just one point back on Europe again. Yesterday, Spanish 10-year bond yields jumped 75 basis points to well above 7%. Today, they fell 60 basis points. The equity market climb in Europe barely skipped a beat around the time of the release of the US jobs numbers, just a gradual climb upwards. The jobs numbers probably helped in the US, although some would argue that stronger jobs numbers make it less likely the Fed will do quantitative easing again, so maybe it wasn't such a positive for the market. But the way the US markets interpreted it today, there certainly did seem to be a positive. But the point I'm trying to make now is that the European market gain really was about a reassessment of what Draghi said yesterday, and there's, I think, a lot more confidence that the ECB really is coming up to the plate to do its utmost. And that's reflected in the sharply lower bond yields for Spain today as well. Okay, that's it for today, Friday. That's it for this week. Back next week, same time as usual.